All right, so paying off and managing the mortgage. We are now past the contract phase. And first off, even though yes, we do sell most loans off to Fannie Mae and Freddie Mac, we are still going to be servicing, aka collecting payment for most of you watching this. That's how we're currently set up right now. If we aren't going to do that, we'll let you know, but right after closing, you're going to get a lot of junk mail saying you qualify for this or that, or sign up for this or that service or insurance. They're going to say that you're not insured. Don't worry about all that stuff. It's almost all fake and noise. If you're confused with anything, call me. I'll let you know if it's real or not. You just take a picture, screen share, shoot it over to me over text. And then even if you're using an escrow account for your property taxes, you are still going to get a bill from the county. They still have to send you that. For visibility, doesn't mean you have to pay them double or that we're not collecting it for you. One thing I'm very commonly asked is, what if I pay more on my mortgage every month? If you do pay more than the minimum, then all the rest of that money goes towards your principal every month. It's not going to extra interest, taxes, or insurance. It's all going to principal to reduce the balance. It won't reduce the payment though, only the balance, meaning it will then speed up the maturity date or the date the loan is paid off in full. I have a calculator I can send to you to show you how paying extra either every month or paying just more one time or just as a yearly payment will cut off your loan repayments. All right, so payment collection. Should we end up collecting each monthly payment from you, you'll have an option most likely to do a biweekly payment plan as well as a monthly plan. Both are auto pay. The biweekly plan takes about half of the monthly payment amount out of your account every 14 days. So with 52 weeks in a year, you end up making 26 half payments or 13 full payments in 1 year. So that equates to a full additional payment every year. All right, this helps you pay the loan down faster, reducing the amount of interest you pay over the life of the loan. So this can shave off a few years off the repayment of your loan. There's no fee to apply, and you can switch in and out of this without penalty down the road. All up to your preference. Now there's one wrinkle to paying extra to the mortgage. It's called recasting. Not to be confused with refinancing. This is a way to trade cash for cash flow, and this actually does decrease the payment, unlike what I just talked about. It's not available on all loans, especially not on FHA or VA right now, but on most conventional conforming loans, it is. But what happens is you take a large lump sum of money, apply it towards the balance, and your payment decreases while your loan length, your term, stays the same. Contrastingly, if you were to make a one-time principal balance reduction and you didn't execute a recast with it, well, your monthly payment would stay the same, but your time left to repay the loan would decrease. So this gives you payment flexibility. Some common instances where a recast is popularly used is when borrowers get RORT bonuses, they receive inheritances, they sell off other properties, they've got stocks or CDs they feel have matured and more. Now you're going to pay more interest over the lifetime of a loan if you recast a chunk of money versus not recasting, but this gives you the option to lower your payment, which is why people really like it. You can do this as many times as you want outside of 90 days after closing. It may cost several $100s, even up to $1,000 in fees, and there's a minimum amount of money you need to apply to the balance. For example, I think it's $10,000 is what we have. Now your interest rate does not change, doesn't require a credit pull, but an awesome tool. It's called the recast. And now for probably the most important reason why anyone buys a house, what I call the 3 net worth levers, the financial benefits. These can increase your net worth in 3 ways. Number 1, your home value is expected to go up over time. Number 2, the balance decreases. So with those 2, you increase your equity over time. Number 3, the one first-time buyers rarely know is that your payment is often tax deductible for the interest and property taxes. So if it does give you a tax break, then the real cost of the payment is lower than your actual due monthly payment instead. All right, so what I just mentioned, the tax break you get from your home. How do you calculate that? This is huge and often overlooked. At the end of the year when you file taxes, you get to shield an amount of your claimed income away from the government so that they can't tax you on it. You can take one of 2 options, the standard deduction or the itemized deduction. You can't do both. Number one, the standard deduction is a number that changes every year based on whether you file your taxes solo, head of household, or married jointly. It's the same for all Americans who file standard in each of these statuses. And number two way you can file is your itemized deduction. This adds up all the primary home mortgage interest you paid in a given year,
plus a capped amount
of property and state income taxes paid in that year. So the itemized deduction, unlike the standard, is different for everyone. Whatever amount is higher for you, you take that to save the most in taxes. If you've never owned a home before, then you've almost certainly picked the standard deduction each year, because without owning a home and paying mortgage interest, it will have saved you more on taxes taking the standard deduction than itemized. Now I'm speaking off rules based off the tax code enacted in 2017, so this applies to any mortgages made then or after. But for a quick hypothetical, if your standard deduction number was $20K, but the itemized total of interest and taxes was $30K, well then you would take the itemized total of $30K, which allows you to write off $30K minus $20K equals $10K more than standard. So you're shielding $10,000 more of income away from the government just by having a house. If your tax rate on that 10K was 25%, then you'd have saved 25% of 10K is $2,500, which is just over $200 a month in a monthly equivalent. Now, 25% isn't even a real marginal tax rate, but it's close to the 22, 24, and 32% common rates. Now, there are other things that you can add to this to increase your home's tax break, and more things that can also complicate it or make it different, but again, consult with a CPA or tax advisor to be sure your situation. Now, here's a juicy one in terms of wealth management, payment strategies. And you want to consult with a financial advisor before executing on something like this too. But some people, believe it or not, they have mortgages they never care to pay off. They never care to own them free and clear. Now, this might not be the case with everyone, but for people with very low rates on their homes, they have the opportunity to stay liquid, just pay the minimum payment every month. And instead of paying down the mortgage faster every month, they will send their money to their investments, their retirement funds, 401k, nest eggs, higher interest rate loans, and rainy day funds. People ask themselves, why knock out lower interest rate debt and instead send that to the market to gain 5 to 7% or more over the long run? Okay, what you do with your money is your choice. But building wealth is a young person's game because you've got more time to put the power of compound interest investing in your favor. The takeaway here is that there are tons of ways to build your wealth with a mortgage. I've also got video goes deeper on it right here. Refinancing, in my opinion, before you buy, you really ought to know how refinancing works in the future. Now, you refinance for one of several reasons. You can, one, refinance into a lower payment or rate, or you can take cash out of the equity of your home to remodel or for some other priority. Or number three, you can refinance as part of a divorce payout. You will have to qualify for the loan again on the refinance. So we will have to check your credit, income, and your home equity and make sure you have enough of each for the new loan. But two things a lot of people don't realize is, one, you won't have to bring a new down payment as long as you have some catastrophe with your home value. And two, the reduced set of closing costs can be wrapped up into the new loan. Won't have to be paid out of pocket unless you have to pay for an appraisal. Those closing costs can be wrapped into the loan if you do have enough equity at that point. But I'd say over 90% of people, they have the costs added into the new loan amount and don't want to pay them out of pocket. Final part here, guys, the advantages of being a landlord after you're done with the home are many. The rental tax rate is about the lowest out there. It's often much lower than what you get taxed on your stock income and, of course, your earned income. Also, rentals do great in recessions. The amount of renters usually does increase a little bit over that time. It's also going to outlast, if you think of it, Apple, Amazon, Google, all those companies out there. They're all going to go out of business eventually, whereas your rental can still be making money for your heirs in 100, 200, 300 years. All right, so don't dismiss the idea of being a landlord in the future once you're done living in the house. You can get a property management company to take care of it for you. I know some good ones. But guys, that's it. I hope that taught you a heck of a lot. You might be ready to apply now. You can always text me for that. But let's talk soon, and looking forward to seeing you at the closing table soon on closing day. Thank you very much.